Individual investors are turning their backs on financial advice and portfolio management firms in favor of DIY or even new digital robo-advice. Those who do stay appear resigned to tolerating poor value service because they think all firms are the same and they don't have a choice. None of this is surprising. Our industry has been letting you down for years. It forces standardized investment solutions on you that fail to meet highly personal and specific wants and needs. And even though it knows real expected returns from markets are quite low, a sensible assumption for a moderate risk portfolio is 3% per annum after inflation. Independently assessed total costs of around 2.6% per annum defeat the object of much of what firms do. What if you could design your own more valuable service, doing the things you want at a sensible price? Let's take a look at how you might do that. We need to think about all the activities wealth managers perform that are potential sources of value. But before we can do that, we ought to think about how we might measure the benefits delivered in terms of usefulness. That's about importance for outcomes and predictability, about the certainty of the outcomes against cost of delivery. So let's start with outcomes. Think of these as the former benefits you want from your investments, such as how quickly you'll be able to acquire a property, or how much you'll safely be able to spend in retirement and when to retire. Not every investment activity contributes equally to outcomes. Some are very important and some contribute much less, simply because, on the evidence of investment returns, they're not highly associated with cumulative outcomes. Outcomes alone cannot define value, however. We're going to need to measure cost as well. Every source of value has a cost of provision, be it the labour or time costs of an advisor or a portfolio manager, the costs of any chosen investment product, or the cost of the utility functions of investing, like safe custody and carrying out transactions. Now we have our matrix, we can start to fill it with investment activities. Obviously, you want to buy activities that score high on importance in explaining outcomes and low in terms of cost provision. You want the things firms do to be here in the high-value activities zone, and not below the diagonal in the low-value activities zone. Before we actually add any activities, however, we need to consider a third dimension in the value matrix, one perhaps less intuitive than outcome or cost, but one of no less importance, which is predictability. Activities that are manageable and have more certain outcomes should be valued higher than those that are difficult to manage well, and which have poorly predictable or even largely random outcomes. And so, we'll use bigger bubbles for activities with high reliability, and smaller ones for those with lower reliability. Okay, now we're ready to start adding activities. We'll start with the most obvious, stock selection and market timing. If you see your advisors as they see themselves, as being in daily competition with the millions of other people trying to win in financial markets, then you'll see what most occupies their attention is the placing of these bets on which stocks and funds will do best and whether the market will rise or fall. It's where the egos are biggest, but the bubbles are smallest, and it's an expensive space to compete in. Active managers and active funds come with high salaries and high transaction costs, but the payoffs are hugely unpredictable. In 11 categories of retail funds managed in the UK, the majority underperformed their benchmarks over 10 years. The worst being UK gilt funds, with 95% underperforming. Even the best category, UK equities, saw 70% of all funds underperforming. Even if, against all the odds, a fund were to beat the market, the size of the payoff would likely be too small to contribute much to long-term cumulative outcomes. They're just not big enough. So we scale market timing and selection small and place them low and to the right, deep in low-value territory. So, what should your advisors be doing that would move your activities up into the high-value zone? Have you heard of the 90% rule? It says that asset allocation explains 90% of the returns in a portfolio. Asset allocation is not what individual stocks you have exposure to, it's what types of assets, equities, property, bonds, cash, you hold, and in what proportions. So we've got to put asset allocation decisions high up the importance scale. And because the effects of the exposures on returns are more predictable, it's also a much bigger bubble than selection. The more the asset allocation strategy is standardized, treating you as just a type of investor, the lower the cost and the further to the left. the more the strategy and the way it is managed through time is tailored to your unique needs, maybe even specific not just to you, but to each individual goal for your money, the more expensive. But the cost impacts of tailoring can be reduced by making the whole process more systematic through computer modeling. That moves it back to the left, better, but without the costs of being better. And if systematic management makes the outcomes more predictable, by eliminating the behavioral errors humans often make, we can inflate the bubble a bit more too. And now, let's take a look at tax-efficient decision-making. Tax decisions are not that high in terms of the scope for explaining outcomes and are difficult to computerize, but they have unusually predictable payoffs, so they sit in the center of our space as potentially worth paying for. Finally, here's one that would never appear in most wealth managers' list of value sources: cost savings. Why would you not see your financial advisor as your buying agent or personal shopper, helping you to save money? But that's a tricky thing for the majority of wealth managers to offer when they themselves are the source of low-value activities. At FowlerDrew, we designed our service specifically to deliver only these high-value functions, completely avoiding all low-value activities. Everything we do for you is in the zone. It's customized and it's systematic, all of which allows us to provide you with the more important, predictable and cost-effective service. FowlerDrew, the smart approach to managing your money.